In this quick video, we're going to talk about the difference between a balance sheet and an income statement, really from a data perspective. Balance sheet and income statement are two pretty common accounting terms that when it comes to a more technical approach, the question often comes up, well, how do we store this information effectively inside some kind of a financial tool to make sure that we can support all the different types of reporting and forecasting requirements that may come up. So let's start with some definitions. What are financial statements? So we've got our balance sheet or income statement. And a balance sheet is really how much is the business worth right now, less liabilities, and how much equity is left at a point in time, as at a point in time. So that's different from income statement, where income statement is saying, so how many sales did we make, less our costs, how much profit is left over a period of time. So there's two different perspectives here, is balance sheet being a point in time, on income statement being over a period of time. So you may see a balance sheet will say, you know, this is the status as at December 31st, whereas an income statement will say this is the income statement for the year, over the 12 months of a year ending at a certain point. So given that, what is the data we really need to support those things? So a couple of principles to start with. We always start with the activity at the lowest green. So that's something that I'll probably drill in a little bit here. So we're not starting with year-to-date numbers, we're not starting with balances. Everything derives from activity. And some of you may be saying, well, what about opening balance? What about balance sheet? So don't worry about that, I'll get to that in a moment. So from an income statement perspective, it's really a simple case as we sum over the periods. So if we want to know what the income statement balance is for our revenue, you know, over the first 3 months, well, we just sum up all the activity in those 3 months. So it's a simple sum. For balance sheet, how would we do it? Well, we really want to be able to show year to date, including the opening balance. So when someone asks, how much cash do we have? They're not looking for how much cash has come and gone out of an account in this period. They want to know, well, what's the balance in our bank account right now? So by nature, balance sheet accounts show balances, which from a data perspective is really just year to date with an opening balance. So I'll illustrate that in a moment, but before we get to that, let's talk about dimensions for a bit. There's two dimensions in particular that support a good analysis of this. So if we look at the time dimension, what folks could have if we think of time being, you know, a full year, breaks out into different quarters. And we also have an opening balance. So think of periods as 0 through 12. You know, if we think of a standard calendar year, maybe the P0 would be our opening balance, P1 would be January, P2 February, you know, all the way through to December. And they each roll up into a quarter, and that rolls up into a full year. And that gives us a dimensional structure to represent what we understand as a full year. Commonly this would be a calendar year, but from a financial perspective, it's very common that a financial year is not necessarily a calendar year. So maybe you want to split this out. You might have one hierarchy for the calendar, one hierarchy for the financial year. Either one's fine, but this gives us a representation that we can work with, so that we know where our individual periods go, where we're really going to store the data, and how it aggregates up nicely. And along with that, we want to have a value dimension. These can be called whatever makes sense for your application, but we want to start with something where would be an opening balance. What's the activity in that period? What's the accruals that someone may want to enter on top of that, or some kind of an adjustment? All that, we add all those up, that should give us the closing balance for that account. Now, if we're looking at an income statement account, you know, maybe there's probably no opening balance because you don't need it. The activity is just whatever happened. Probably, and we might not need a accrual, we might not need an adjustment. So this gives us, if we're storing all of our data in activity for an income statement account, it rolls up nicely to give us our closing balance. Also, if we were to look at a balance sheet account, well, the opening balance, well, that's just the period before. So we can put a little rule there to give us that. The activity, well, we know that's wherever we're loading in from our source system, or whatever we're having users enter. So what's happened in that period. Accruals could be things that happen on top of that. Similar with adjustments to give us our closing balance. So let's pop over to Excel now. We're going to look at what this looks like from a formula perspective. The yellow cells here are really data. So these are the actual things that they're rows in a table or tuples in a cube somewhere that give us these individual elements. So for a particular account, we're going to have, that there was, and this one I've left the example on the main line here just to make it more simple, but this one is in bold italics because it really only applies to a balance sheet account. A balance sheet account would only ever have an opening balance in that P0 period. So think of this as our opening balances for whatever accounts they apply to, and these other cells are just activity. So if we have 10, we have, say, activity of 10 in each of the 3 periods, well, that rolls up into a quarter, that's 30 in the quarter. Another 10 each period gives us 30 in the second quarter, so on and so forth. Notice how this initial balance is not included in the quarter. So this is something special that we want to only consider when we're looking at balance sheet type of accounts. Year to date, quarter to date, year to date are all formula driven. So we don't need to store anything to those. Those can be either, depending on the technology you're using, could be a cube in analysis services or rules in TN1 or just formulas in Essbase. For a balance sheet, really it's the same kind of thing. I've listed them as gray here, but it's really the activity, and we calculate out these balances. So the balance that someone would want to report is really a reporting piece. It's still read-only, because it's just going to look back and say, okay, well, this is the activity that we loaded for this account, but this is a balance sheet account, so they'll want to see a balance. And this just, as you can see, shows us, it does include this opening balance, and shows us the balance at each piece. Now, full year is contentious. What should the full year balance for a balance sheet account be? It kind of depends. It depends on what you're looking at. But for the most part, for quarter to date and year to date, we're seeing the same things. So what I want to highlight here is if you're looking to store data in some kind of financial tool, always store activity. Have some kind of a period called P0 where you store any kind of opening balances if they're required, and then your different periods, probably 1 through 12. If you're storing just that base level data, that green, you can figure out everything on top of that. If you started with year to date, you stored year to date numbers, you could probably derive the other pieces, but it would be more complicated because you need to start figuring out differences every time. Whereas if you start with activity, it's more natural sums. So just to recap, we talked about the financial statements. What's a balance sheet? What's an income statement? What balance sheets point in time? Income statements over a period of time. We always want to start with activity at the lowest grain, not year to date, not balances. Everything derives from activity. It's like income statement from a data perspective, if you're looking at tables or cubes, it's going to sum over the period, where a balance sheet is really going to show the year to date, including the opening balance. We've also looked at how our dimension structures can help us here if we're using some kind of a full year with an opening balance in our 12 periods, along with some kind of a value dimension where our opening, activity, accrual, and adjustment periods roll up into the closing, and that gives us something that we can work with pretty easily. Hope this is helpful, and let me know if you have any questions.